There are rules set up to protect people if in the event that both the insured and the primary beneficiary die at the same time or in the same event. What's that called? That's called a common disaster. And there's actually a simultaneous death law. That's a mouthful. Simultaneous death law. What that means is that if both the insured and the primary beneficiary die at the same time or from the same event, then the contingent is the person who would be the beneficiary, not the estate of the primary beneficiary. So you can see that would come up. Let's look at the example from before. We have Betty and John. John is the primary beneficiary. Matt's the contingent beneficiary. If Betty and John die at the same time, then Matt now becomes the beneficiary, not John's estate. Okay? Now, in some insurance policies, there's a clause for this, and it's called the common disaster clause. And this is meant to protect the contingent beneficiary. Now, they can die separate times, too. So, like, for instance, say Betty and John are both in a earthquake. And Betty dies, and then John dies a few days later. Since they died in close proximity from the same event, then Matt is still the one who receives that benefit. So it wouldn't go to John's estate, right? So in that case, these rules protect the contingent beneficiaries.